All right, let's get right into it. Quick disclaimer first. This is for educational purposes only. It is not financial advice. All investing carries the risk of loss, so please do your own homework. We're about to break down a massive market shift that almost nobody is correctly positioned for. You gotta forget the mainstream noise, because the hard data is telling a completely different story. Hit the like button, subscribe to the channel, and comment your top ticker right now. Retail is drawing lines on charts, while the smart money is preparing for a decade-long sideways market. Legendary forecaster Larry Williams just warned that 2026 is the start of a massive liquidity drain. Today, we expose how to read the COT report and rotate into physical monopolies before the S&P 500 goes flat. So the entire catalyst for this thesis comes from one of the legends, Larry Williams. His cycle analysis, which you can track yourself over on stock charts, is pointing to a major market low and inflection point coming in 2026. And look, this isn't just another wild prediction. It's rooted in decades of cyclical data that have nailed major market turns with frankly stunning accuracy. But here's the absolute crucial point. This cycle isn't some mystical chart pattern. No, it's grounded in a harsh macroeconomic reality. We are looking at a massive liquidity drain that's being driven by what are basically mathematically inevitable government deficit cuts. They have to service this unsustainable debt. So as that fiscal tightening kicks in, the broad market and especially passive indexes like the S&P 500 is going to be starved of the very capital that has fueled this incredible run-up. So the big question is, how are the institutions, the smart money, getting positioned for this? We're about to expose their playbook by reading the footprints they're leaving right in the data. Look at the screen right now. On the left, you see the retail strategy. They're drawing what we call chicken scratches, just meaningless trend lines on an S&P chart, and they're programmed to just buy the dip. Now look at the right. That's the institutional playbook. Notice the massive dark pool accumulation in very specific sectors happening at the exact same time the commercials are dumping the broader index futures. I mean, this is textbook VWAP absorption. The RSI divergences are screaming rotation. What's really happening here? Institutions are using retail's dip buying as their exit liquidity. It's that simple. And the primary tool we use to track this is the Commitment of Traders report, the COT report. Now, we ignore the speculators. The only group that matters are the commercials. These are the real players, the producers and the end users. Think corporations that are actually dealing with a physical asset. They are not gambling, they are hedging real-world supply and demand. Their positioning, bar none, is the purest signal of true institutional sentiment you can find. And this is what that raw data looks like. This isn't an opinion, it's not a forecast. It's a quantitative record of where capital is flowing. By tracking the net positions of these commercials in key markets, we can see exactly where the real money is moving, often weeks, sometimes months, before the price action even begins to reflect it. Okay, so let's tie this all together. Here's the translation layer. In plain English, this means Wall Street knows government cutbacks are draining the money supply. They are using retail buy-the-dip liquidity as an exit strategy, simultaneously rotating that capital into the physical AI grid and gold miners. The thesis is simple. You cannot print your way out of a physical energy deficit. Before we map out the bear and black swan scenarios for this trade, hit subscribe so you don't miss our weekly dark pool audits. Okay, so if capital is flooding out of the broad market, where is it hiding? Well, it's rotating into the one area where demand is absolutely non-negotiable, and supply is physically, fundamentally constrained. Let's start with a hard number that's almost difficult to wrap your head around. Alpha Labs research projects that AI hyperscalers are going to deploy $370 billion in CapEx in 2026 alone. This isn't speculative tech spending, folks. This is a desperate, frantic rush to build out physical infrastructure. And all this capital is just smashing into hard physical limits. The AI build-out requires a staggering, almost unbelievable amount of power, and that's creating choke points in everything from transmission transformers to the nuclear fuel cycle. These are thermodynamic realities. You can't just code more electricity or 3D print a nuclear reactor. This is where demand becomes inelastic, and that's exactly where smart capital is flowing. And that brings us to the specific targets. You've got a power producer like Vistra, ticker VST. It's a direct play on the AI grid's energy needs, a thesis that was just validated by their massive $4 billion acquisition of Cogentrix. Then you have next-gen nuclear plays like Oklo, ticker OKLO, which already has a deal in place with Meta. And of course, in an environment of fiscal tightening, you have debt-free physical assets like gold miner Newmont, ticker NEM. which gives you direct leverage to the price of gold, a classic safe haven. Now, any robust thesis has to account for all potential outcomes. So let's map out the three primary scenarios we see: the bull, the bear, and the black swan. The bull scenario is our base case. The S&P 500 enters that decade-long sideways chop that Williams cycle analysis predicts. Meanwhile, the physical asset plays we've been talking about, which are driven by their own idiosyncratic demand, they completely decouple from the broad market and deliver just parabolic returns. Now for the main risk. In the bear scenario, that liquidity drain is way more severe than anyone anticipates, and it triggers a systemic deflationary crash. In that kind of environment, correlations all converge to one, and all equities, everything, reprices down to key technical levels, like their 200-day moving average. And finally, you have the black swan. This is your low probability but incredibly high impact event. The CFTC could, for whatever reason, suspend the publication of the COT report. That would instantly blind thousands of quant algorithms that depend on that data, and it could potentially trigger automated, market-wide liquidations as all their risk models just completely break. So given these risks, having a non-negotiable risk protocol isn't just a good idea, it's absolutely mandatory. This is how we defend our capital. Listen closely, this is the mandatory protocol. There are no exceptions. Step 1, defend your baseline. Every single position must be bracketed with a one triggers other, or OTO order, using a 2.5 times average true range trailing stop. This is purely mechanical, zero emotion. Step 2, reject weakness. We have an absolute ironclad rule to never, ever hold a long position in any asset that is trading below its 200-day moving average unless you have an explicit hedge in place. This isn't about being right, it's about staying in the game. If you want to trade with a quantitative edge, hit the like button, subscribe to the channel, and drop a comment below with your specific thoughts on Larry Williams' forecast and the tickers mentioned, NME, VST. So I'll leave you with this one question to think about. As the line between digital demand and physical limits gets blurrier by the day, is your portfolio actually positioned for the right side of the coming liquidity drain?